In 1980, $46,000 of income got you in the 50% tax bracket. In that year, there was a 73% tax bracket. So today, the highest marginal tax bracket's 37%. So looking back, these tax rates look really low. I think the first step to reducing taxes is to have a clear strategy for how you're going to take cash flow from your investments, from your resources. Some of the assets retirees have are taxed at ordinary income tax brackets. Some assets are taxed at long-term capital gain tax brackets. There are dividends, then there's Social Security. For most people, a good portion of Social Security benefits is going to be taxed as ordinary income as well. So having a strategy for how you're going to withdraw assets to manage your tax liability every year in retirement is really the first step to becoming tax efficient. When we look at minimizing taxes, we're looking at minimizing taxes in the whole retirement timeline, which might mean that it makes more sense to create tax liabilities in the short term, which might seem counterintuitive. But if we believe tax rates are going to be higher in the future, it doesn't make sense to defer withdrawals from your taxable retirement accounts to a later date when you're going to pay a future mystery tax rate. So it may make more sense to take withdrawals and spend down your pre-tax retirement accounts first while deferring the assets that have more favorable tax treatment for withdrawals later in retirement. There could also be room for a Roth conversion strategy. But now when you create a tax liability from converting your pre-tax retirement accounts to Roth tax-free accounts, we're not just going to take that tax liability on the chin and do nothing about it. That's, again, an important part of the strategic tax planning, is to deal with any tax liabilities that we need to create to be as tax efficient as possible. I've noticed that a lot of people think taxes are going to be lower in retirement just because they're retired or just because they're at a later age. That's just a giant misunderstanding, and it can be a very expensive misunderstanding. At the end of the day, a lot of retirees have income that's taxed at ordinary income tax brackets because of the pre-tax withdrawals. The withdrawals are taken from their pre-tax IRAs and 401ks. Pensions, in many cases, state and federal government pensions are taxed as ordinary income. Social Security benefits can be taxed at ordinary income tax brackets. Tax rates today are historically low when you consider where we've been. In 1980, $46,000 of income got you in the 50% tax bracket. In that year, there was a 73% tax bracket. So today, the highest marginal tax bracket's 37%. So looking back, these tax rates look really low. So it's important to understand your tax liability in terms of how is the IRS going to treat withdrawals from every kind of asset you have, and then work to put together a strategic tax plan to be as efficient as possible as you take income in retirement. I'd say the very first decision you can make and should make is to have clarity, have a clear understanding of where you are, what tax liabilities sit on your lap because of the resources and the assets that you have. How is the IRS going to treat withdrawals or transfers? How is the IRS going to treat that money or those assets when it's passed on to a surviving spouse or to your children? These are really important questions to get answers to. So the very first step is to be clear about your situation. Then when you have that high level of clarity, you can identify opportunities to take control. There's a lot of things that are outside of our control. You can never plan away every variable in life, but there's so much within your sphere of influence that you can control, but it's very difficult to identify those things if you don't have a high level of clarity. So a common strategy we use is, again, if we believe tax rates are going to be higher in the future, then we're going to want to draw down first the accounts that have the least favorable tax treatment, and we're going to defer the more favorable tax treatment for later. We had a client come in, and this is at least a weekly occurrence, a couple times a week. We visit with folks who just don't have a high level of clarity about their retirement plan. They don't have a lot of direction. They've been working with retail advisors who are employees of big banks and brokerages for most of their life, and so they've never really had an experience with real financial planning. And all they've understood is, well, you accumulate as much as you can, and then you put some money in bonds, you put some money in stocks, and try not to withdraw too much and cross your fingers and hope that everything works out. That's a terrifying way to move into retirement, and it just doesn't work. So we had a client come in this last week that I'm thinking about. They were very nervous about their retirement, and I knew immediately that they didn't need to be. Just taking a quick glance at their assets and their income needs, I knew they were going to be just fine, but they needed to know that they were going to be just fine. And so we have what we call the Vital View. It's a system that we use to produce basically a helicopter view of the client's complete situation. It's on a timeline. It's a one-page sheet of paper. This isn't a 32-page printout, but it gives very clear, detailed, high level of clarity about where their cash flow is going to come from which accounts are we drawing that cash flow, what the tax liability is going to be from withdrawals from each of those assets, and how Social Security is going to play in. When is the right time to file for Social Security benefits? How much are we going to have to give to the IRS from the Social Security benefits because of the taxes? And once they had that high level of clarity, even before we fine-tuned and enhanced their situation, the relief was already there. That's why I say the first step is clarity. The second step is to take control of the things that you can control, and that's the only way to be truly confident in your retirement. We're interested in tax planning because we're so interested in your cash flow. Really, the thesis of your financial plan is your cash flow. It's the amount of money you're going to need after taxes every month and every year to fund your lifestyle. And so because we live and you live on income after you've paid taxes, we're interested in the tax. We want your portfolio to last as long as possible and to be as successful as possible. And so we've got to look for opportunities to reduce expenses, reduce the cost of your retirement. And the biggest expense you may face in retirement is your taxes. And so if you shoot from the hip and you go into retirement without a plan, chances are good you're going to pay a whole lot more in taxes than you should. And that means there's going to be less left for you on the table at the end of the day to fund your lifestyle. And it might mean that you're going to have to go for higher rates of growth on your portfolio to be able to maintain the withdrawals you need and the taxes you're going to have to pay. So that's really why we're so interested in tax planning. There are a lot of tax strategies that take years to be effective. Take, for example, Roth conversions. If you have time to convert your traditional IRAs to a Roth in portions over several years, you could save a lot in taxes by doing that. You can keep yourself within a particular tax bracket each year. We have some level of predictability when it comes to where ordinary income tax brackets are going to be in the next few years. As we get further into the future, it becomes more obscure. We don't know what those tax rates are going to be, so there's a sense of urgency. But if you wait until the last minute, you may be forcing yourself to pay taxes at a higher rate than you really should have been. And the other thing is there are other rules that can come into play that could make it a whole lot beneficial for you to have started sooner. For example, going back to the Roth conversion, there's a 5-year clock on every conversion you make, meaning you have to wait 5 years to be able to withdraw gains, growth from that converted money without paying an IRS penalty. Time is important. And now if you're younger and you're contributing to employer plans, 401ks and IRAs, you may want to start now contributing directly to the Roth strategy so that you're not having to face a tax liability down the road. But the most important thing is that you have a plan. You have a strategy that's tailored to your situation, your timeline, your income needs, your resources, your family dynamic. All of those things matter. There's no cookie cutter approach that's really going to make you feel confident. Well, the vital view really is, it's a guide, it's a compass. It helps guide every important financial decision you're going to make now and into your 90s. Because cash flow is the most important thing to focus on, and we need to see how certain tax strategies benefit your cash flow, that's where the vital view becomes very critical, because we can see that very clearly. And again, this isn't a 32-page printout. This is a one-page sheet of paper that gives us a very clear view of where we sit, and also helps identify opportunities for becoming more efficient. In going through this process with a number of clients, even just taking inventory of all the assets is a huge advantage. And looking for opportunities to simplify, to consolidate. If you're not getting any benefit for complexity, then you need to minimize the complexity. You need to simplify, make things easier to understand, because that really is, that's a risk, to have things so clumsy and so complicated. So it's time to get clear about your assets, about where you sit, about your needs today and into the future. And it's time to get clear about the net income that you're going to be able to generate from your assets. If your advisor is not talking to you about this, chances are really good you're not dealing with a planner. You're dealing with a product salesperson. So one thing I've learned in the 20 years I've been doing this is there are some really great tax professionals out there. Most of them, at the end of the day, are really compliance officers. They're order takers. They're not looking ahead at tax strategies. They're looking in the rearview mirror at last year, and they're filing the reports that are necessary and all that. But a good CPA, a good tax professional, is going to let the tax strategy lead, and they're going to really look to the financial plan for what we're going to be doing with taxes. So the financial plan is really driving the tax strategy, and then the CPAs and tax professionals are going to be the compliance officers along the way to make sure everything's done appropriately. If you don't have that high level of clarity about what your tax strategy is, you're just going to have a level of anxiety that's just not necessary. And a lot of people are dealing with this, and so we're on a mission to relieve that for as many people as we can. If you look at the taxes you owe while you're working, it's mostly going to be ordinary income taxes for people who are W-2 employees. That is the least favorable money in terms of tax treatment. If you're a business owner, of course, that can be different. You can be a W-2 employee of your own business. You could also take distributions from your business, and there can be some really effective tax strategies there to minimize or even completely eliminate the tax liability for distributions from your business. When you move into retirement, you're going to, if you're like most people, you're going to be relying on your investments and the assets that you've accumulated, and they all may have different tax treatment. Your traditional IRAs are pre-taxed, and it's taxed as ordinary income. You have your brokerage accounts where you can get access to long-term capital gain tax treatment. You can take losses, apply the losses against gains, so you can be a little bit more creative there. Then you have your Roth accounts, which are going to be potentially all tax-free withdrawals from those accounts. Then there are other financial products and investments that can offer their own tax incentives, independent of the IRAs. Life insurance, cash value life insurance can be a popular one. Private investments, alternatives. There are private real estate investments you can get into that give you very favorable tax treatment because you have depreciation and deductions that are getting applied against the income that's getting paid to you. Of course, there's renewables and oil and gas and all that. The most important thing for you is to know which of all of these resources and strategies and products are relevant to your situation. And the very first step to identifying that is to get a very clear view, a high level of clarity about your situation. And our portfolio review is a good way to do that, which includes the vital view, which will give you that helicopter view of your entire situation. And that's going to be the best first step in this direction.